the founders of Trading RM, and I'd like to welcome everyone to our co-sponsored webinar with Lex Securities and Trading RM, how equity traders can increase returns by trading options. On the webinar is Larry Fisher from Trading RM, Chuck Mack and Michael Beaver from the NASDAQ, and Mitchell King from Lex Securities. The webinar should last about 30 minutes or so with some Q&A afterwards. We're going to open up the Q&A so you can either put something in the chat or use your phone and ask questions. So let's get started. What's the objective of this webinar? Trading RM has developed a strategy that allows equity traders to take advantage of the changes in the option marketplace. The goal of this webcast is to illustrate ways an equity trader can express their trading strategy via options. We believe that traders can take less risk while still benefiting from unlimited upside. Regulatory changes and how they affect traders. There have been regulatory changes to the option marketplace that have been favorable to day trading options. The Penny Pilot program was implemented in January 2007. This program was designed to test the way options were quoted. Historically, options had been quoted in 10-cent increments, which made it difficult to day trade options. The program started with roughly 30 symbols that would be quoted in penny spreads on option prices under $3. The pilot program was very successful. Currently, there are over 350 symbols that are quoted in penny spreads, which allows one to trade these stocks that are quoted in penny spreads on an intraday basis. In May 2009, the NASDAQ put the study together on the Penny Pilot program, and they reported the following. Compared to before the Penny Pilot, quoted spreads declined, quote size at the inside declined, and quote traffic increased. The results in our analysis reflect the combined impacts of the Penny Pilot and increased volatility in financial markets as reflected in the VIX. Compared to the previous analysis in the latest period, quoted spreads declined, quote size at the inside increased, and message traffic decreased. These trends are partly caused by the decline in perceived market risk compared to the previous period. Another recent change that's come about is the advent of weekly option expirations. There are about 30 or so symbols that change every week that expire the following Friday. These options are listed on Thursday and expire the following Friday. These include stocks like Apple, Goldman Sachs, Google. There are also indexes such as SPYs, Qs, and IWMs that also have weekly expirations too. The expiration week has historically been a period that is usually our most successful week of the month. Now we have expiration week every week. This is very good and powerful for the day trader. One of the reasons why this period has been so successful for us is because options go from low delta situations to high delta situations. For those of you who don't know, delta is the change of an option price corresponding to a 1-point move in the underlying stock. Let me give you an example of a low delta to high delta situation. Some of you guys might have seen this on Friday with Apple. So the Apple calls, 310 calls that expired that day, were trading at 10 cents when the stock was at 3 or 7 or so. At that point, they were about a 20 delta. As the stock increased, the delta exploded and went to 100 late in the day when Apple was at 315. These options closed at $5, the 315 minus the strike price of 310. So you had a huge move in that option price from 10 cents to $5. This was a result of a couple things. One, the stock price increased dramatically, along with the deltas increasing significantly. As this example shows, as the stock price moves higher, the deltas increase, thus increasing the size of your position. That is one of the inherent benefits of trading options. So when positions are working for you, the size of your position is getting bigger, and the opposite holds true when it goes against you. The position size decreases as it moves away from the strike price of the option. Fee structure. Fee structure is another benefit of trading options. As you can see, the costs associated with trading options are very low. Each option contract gives you the right to buy 100 shares of stock, so the cost of trading options relative to the size of your position is minimal. In addition, the last year, exchanges have moved to the maker-taker model. This model allows traders to be compensated for adding liquidity to the marketplace. The term adding liquidity refers to sending an order to an exchange at a price which is not immediately executable. the order sits on an ECN's order book until the market moves to that price, at which point the order executes. You can think of this as a limit order, and here's an example of this. The inside market on the Apple 310 calls is 101 by 105. If you place a buy order at 104 or below, the order will sit on the book until another market participant is willing to sell at that price. Alternately, you can place a sell order at 102 or higher, and your order will sit on the book until another market participant is willing to buy at that price. Buying on the bid and selling at the offer is referred to as adding liquidity. Traders will also pay the exchanges if they take or remove liquidity. The term removing liquidity refers to sending an order at a price which is immediately executable. A buy order is sent with a price equal to or higher than the current offer, and a sell order is priced equal to or lower than the current bid. You can think of this as a market or marketable limit order. As you can see in the example on the slide, for the NASDAQ fee structure, you will receive a 32-cent rebate to add liquidity. If you remove liquidity, you will be charged 43 cents. For the Philly exchange, you'll be rebated 20 cents for adding liquidity and 25 cents for removing liquidity. Another benefit of trading options versus equities is your capital requirement. The capital requirement for trading options is far less than for trading equities. Let me go through this example on the slide. We have the Apple 270 calls that are priced at $4.45. One option contract is equivalent to 100 shares. As you can see, the 270 call has a delta of 35. So if you buy 100 of these calls, we'll have 3,500 deltas or 3,500 shares. This position would require a capital outlay of $44,500. The same position in stock would require a capital outlay of $915,915. This is 3,500 shares of stock times the 261.69. This difference is over $850,000. So you can see that the benefit of trading options is a huge reduction in capital. And the amount of money that you will make or lose is pretty consistent unless you see a huge jump in volatility or a decrease in volatility, which doesn't come up a lot considering our short-term nature of the options. The next example of trading options versus equities is taking into account the last week of option expiration, and that's being able to utilize stock versus your option position. In the example on the slide, we bought City calls at 7 cents. I'd be looking to sell the stock at 407 or higher so that I would guarantee myself a free trade. The benefits of selling the stock instead of the option is to take advantage of a big reversal in the stock. I'd be looking to buy back the stock under $4 to lock in some profits, and I would still have the option on. If the stock continues to go up, I'm perfectly hedged, so the trade would be a scratch. We'll look to put this trade on Tuesday, Wednesday of option expiration week, so you can take advantage of the movement in the stock. If you'd like to learn more about these situations, please feel free to go to our website, tradingrm.com, and there's some seminars that explain how we take advantage of this stuff. Another benefit is the reduced bid-ask spread. As you can see in the ROX Level 2 window, the 15 call has a spread of a penny. The fact that it's a penny wide allows one to trade the options without giving up a tremendous amount of edge. This has been a huge benefit of the penny options, where there are over 350 symbols that trade in pennies. It used to be very difficult to trade options on a short-term basis when you were giving up 10 cents or more to get in and out of an option. Now you give up very little edge to be involved with the position in options due to the tight spreads. Recently, the NASDAQ market allowed you to put penny bids and offers in on options that quote in 10-cent spreads. This allows you to trade additional names that are not part of the penny program in penny increments. This is a great addition to the option marketplace, especially for the day trader. Less crowded market. Another benefit of trading options is the fact that there's a less crowded market. There are many situations where you're creating instead of taking liquidity in the option market due to the fact that it is less crowded. This allows you to get a rebate for trading as opposed to being charged for trading. There is also less computerized trading in the option market due to the fact that there are thousands of option classes. Now I'll turn over to Larry Fisher, who will talk about some of the tools that we use at Trading RM in our daily trading.
Thanks, Reed. Reed did an excellent job of describing the current landscape of the options trading marketplace. When we realized that many of these rules were changing and many of the exchanges were changing their fee structures, we realized that we needed to have some help from technology to keep our edge in the marketplace. So what we did is we created some trading tools. First thing that we created is called the OptionBox Technology Smart Order Form, which you can see a snapshot of on your screen. Now, we went out to find some technology in the marketplace that gave us an edge or allowed us to trade in and out of these options with their new rules efficiently, and we were unable to find a product, so we created it ourselves. There are several key and exciting tools and functionality on this product that I'm going to highlight today. First of all, many of the front-end systems are not geared towards trading penny increment options, meaning that they're set up to trade the traditional way of nickel and dime increments. There are very few tools that allow you to trade inside the bid and ask spread in the options marketplace. So we created this tool that allows us to create liquidity by trading, as Reed said earlier, putting orders in that are not immediately executable, which does two things. First, it allows us to create liquidity where we receive a rebate from the exchanges. And second, we end up getting filled at a better price than if we would just have taken the offer. Someone might say that that's good in theory, but what happens when the market's moving very quickly? Well, if you look at the middle of this form, you'll see a column called Smart Buy and Smart Sell. And what this does, this technology places smart orders into the marketplace to take advantage of, first, the being able to be executed mid-market in options, and then second, being able to move with the market and be executed in a timely fashion. So for example, if you were to hit Smart Buy, this button will start the process of bidding near the bid and incrementally move, cancel, replace your orders until you're filled up until the offer price. Now, why is this important? Well, this is important because in options pricing, each market maker or participant might have a different fair value on an option. So let's just say, for example, if the current market of an option is $1.10 bid to $1.06 offer. If you want to buy that option, what price will you put in as your first price? Well, you could just take the offer at $1.06. However, there's a chance that you could get filled at anywhere between $1 and $1.06. So our technology will start searching liquidity to get filled better than on the offer. And like I said earlier, not only are you getting a better fill, but you're also getting a rebate from the exchanges. We've also incorporated many programmable hotkeys that allow you to buy and sell at different prices. We've also included technology that helps you manage risk. For example, if you look at where the cursor is, where the red highlighted number is at $2.18, this is a level, an automatic stop limit order functionality, where if you were to buy an option at a certain price, you can set a stop loss based on percentage basis and have that order automatically put into the marketplace so that you're immediately limiting your downside.